Okay, so we are recording. Today is Monday, November the 14th. Let me share my desktop monitor 1 with you here. Okay, as you can see, we're right at 2 o'clock post time, 7 p.m. over in London. And I want to just start my PowerPoint up. Today's topic is trading psychology. Why would we want to study psychology? Psychology is about thought, emotion, behavior. Psychology studies the human mind and how it causes us to behave. So it seeks to explain, help us to understand our thoughts, our emotions, and our behavior. Now, how can psychology help you as a trader? Well, it can help us to perform better. It can help us to see what's wrong with ourselves, and it can also have a fancy word there called ergonomics. I actually had no idea what that was, and my son was a psychology major in college, so I went upstairs and said, "Hey Ben, what does ergonomics mean?" And he says it means making things easier. So I think there's a lot to be gained here by putting psychology in the mix. Certainly, if we can think better, that will make us a better trader. Now, thinking, okay, trading psychology, it can be a huge plus, but let's not put the horse before the cart. There are 3 things every trader needs that come before considering the psychology of trading. What are these things? Number 1 is you need a profitable trading strategy that can help you to make money in the real world of trading. What I mean by the real world of trading is not some back-tested hocus pocus, some fudging of numbers and optimizing numbers and call that a trading strategy or a trading system, but a knowledge of what the market is about, understanding the market itself, and from there coming up with a strategy which would be a combination of things that makes sense, that has an edge on the market. Once you have that in place, along with a sensible risk strategy, you need to have a pretty good idea of how to take risk on your trade. Once you have these things in place, once you have a good strategy, once you understand the market you're trading and how to take sensible risks, not to overtrade, take too much risk, then I think we can move on to the subject of psychology. Now, why do so many traders fail? In my estimation, the main reason that most traders fail is they think it just appears that trading doesn't seem that hard. So, for example, here we're looking at a weekly chart of the euro-dollar pair. And down here around 120 and all the way up close to 160, just week after week, going up, going up, going up. And it's very easy to talk yourself into saying, this doesn't look so hard. You buy it, it goes up, you sell it, you make a lot of money. And the internet doesn't help. They seem to give you the impression between the spread betting platforms, the broker platforms, the software salesmen, just about everybody who talks about Forex and doesn't actually trade it, they make it seem so easy that even a monkey could do it. So hence, I think we tend to underestimate the difficulty of trading going into it. And I think that's a reason many fail, is because they get the idea, they're told that anybody can be a trader. And that's kind of a silly statement, you know. That's like saying, you know, anybody could be a professional basketball player, or anybody could be a brain surgeon. You know, I don't think it's quite that easy. And it's not even the fault of the retail trader a lot of times. It's the fault of the media, specifically the internet community. A good place to start when you're thinking about this is, why would you want to be a trader? For many of us, it's the action, the excitement of trading. For others, it's the money and the security that would bring. The freedom is awesome. It could, working from home and just need your computer and not putting up with any of the bullshit of work. Of course, this is really attractive. And still for others, it's just a challenge. Just the challenge of trading is what draws people to it. So I don't think, in my opinion, I don't think you need a genius IQ to trade, but there's a lot more to trading than just looking at a chart and saying, this is what I need to do. And I think it's this shortcoming where a lot of traders fail. If you think of trading as a sport, comparing it to, say, tennis, in tennis, it's all about winning or losing the match. In trading, it's all about the P&L. As far as pressure goes, in tennis, you got a split second. The ball's coming, and you have to decide whether you're going to try and hit it down the line, whether you're going to try and go cross-court, whether you're going to try and go over the opponent's head, whether you're going to try a drop shot. And you have to keep making these decisions in split-second time throughout the match. Very similar to trading, where you don't have a lot of time. You have to make your decisions real quick. So in many ways, tennis and trading are very similar. Now, as far as practice goes, to improve your skills in tennis, for example, this gentleman's taking a backhand shot. I used to play racquetball competitively, and it would not be unusual if I was practicing my backhand to take a couple of hundred backhand shots in a row, just to try and get it to the point where it becomes ubiquitous, where as you're approaching the shot, it's just such a natural motion because you've done it so many times. So in order to hit peak performance in sport, we practice. Practice is considered an accepted way of trying to perfect your game. So to reach perfection, what you're looking for is that flawless execution, say, of a backhand shot, and you get that from practice. This is how you improve your skills. Now, one of the shortcomings of trading is most people don't practice. They just get in there and they do it. And they don't have the quality that say, a sports figure would have. So, for example, one of my systems is called Jimmy's Bands. Could you imagine if you practiced and you did 1,000 Jimmy's Band trades before you actually did a real Jimmy's Band trade? Well, I don't think I'd be getting emails from people saying, well, what's the swing requirement? Does it start at the beginning of the day or is it from the day before? No, I don't think so. I think after you've done it 1,000 times, you would know exactly what's right and what's wrong. So one of the problems that we have as traders, we simply don't practice enough. And you don't have to practice necessarily with fake money, a demo, in order to practice. You can practice with real money, just keep the amount small till you get good at it. But it's not betting real money is why most people have problems learning to trade properly, because they're not trading anything real, so they don't take it very seriously. And also, when you play a sport, you go out and you play once a week or twice a week, and in trading, you do it every single day. So you don't hit that intensity, and you don't have the opportunity to practice and get to top form all the time. It becomes a little bit mundane, and repetitive. So we always need to pump ourselves up to some extent every day. We'll talk about whether that's a good idea to do. I mean, there is degrees of that. We'll talk about that in a little bit. So what you want to take from this is when you're evaluating your performance, the P&L is one thing. Like when you play tennis, when a tennis player plays a match, he either wins or loses. When we trade, we tend to base our performance based upon whether we won or lost, the P&L. How much money did I make? Now, there's more to it than that. What there is execution. And in many cases, a tennis player will be judged how well he played based upon who he played. If the number one player is playing, let's turn that around. If the number 300 player is playing the number one player in the world, well, he's probably going to lose the match, but that doesn't mean he didn't play well. Playing well would mean how did he actually perform in the match? Did he get his shots in when he's supposed to? Did he have a normal number of first serves in or not in? In other words, there's a whole bunch of statistics, and that's how you judge that's how you evaluate the performance, say, of a tennis player in a tennis match, not just whether he won or lost. But in trading, we tend to put too much emphasis on the P&L. So what we should be thinking about is, did I trade well? Did I follow my system? If I have a daily trading routine, did I do my routine first before I started trading? Or did I just jump into a trade? Was I too lazy to check the news? Was I too lazy to look at correlated pairs? Was I too lazy to check the stocks? Did I just jump into a trade because I had a magical signal? This is the things you should be asking yourselves more than what the P&L was. What were the conditions of the market? Was the market trending strongly and you should have easily been get on the trade, or was it a kind of a choppy sideways day influenced by, say, news events where it was just a really difficult day to make money? Well, under those conditions, there's more to it than just the P&L. And it works the other way around, too. On a day where conditions are perfect and you make a little bit of money, well, maybe you should have made a lot of money that day. So there's more to it than in evaluating performance. There's a lot more to it than P&L. In fact, I would go as far as to say, forget about the P&L. Forget about it totally, and just execute well. Know your system, know your market, have good risk management in place, have your trading system, and base your decisions on what you see in front of you. And forget about the P&L. The P&L will take care of itself. The P&L is the result of all those things, and not the other way around. So, you have to think whether you're lucky or good. Your account balance changes don't tell you the whole story about your trading. Some of us could possibly be taking way too much risk in making money, and eventually they're going to crash and burn. Some of us have big winning streaks, big losing streaks. All of these things have something to do with it, because it could be that you're looking really good right now, but when your next losing streak comes along, you're going to be back to square one. Generally speaking, if you can make money without big losses, then you have the best chances of long-term survival. The others who have big losses, big profits, big losses, big profits, or the type of person who can never take a loss, they're just an accident waiting to happen. Eventually they're going to blow up. Now this is a fact. It's a lot easier, and a lot of you can identify with this slide right here. It's a lot easier to identify the trade than to do the trade. I see this on Twitter all the time. where lots of people, oh, there's a signal here, there's this trade there. Did you actually do the trade? No, I'm waiting for something. I'm doing something else. A million excuses not to do the trade. And be mindful that there's no point in identifying the trade if you're not going to do the trade. If you identify what you think is a trade signal, and you look at the stocks, and you look at when the news is coming out, you look at the correlated pairs, you look at the 1-hour charts, everything's lining up to do the trade, and then you don't do it, you don't pull the trigger, well, then there's no point in everything you've done. See, no matter how much trading knowledge you have, no matter how great your system is, it's all going to be useless unless you have the guts to pull the trigger and put some real money at risk. Like they say with the lottery, you got to be in it to win it. But trust me when I say that the simple task of hitting the buy and sell key is extremely difficult to do when you have real money at risk. Now, real money is a relative term. So perhaps if you're making a 1-pound bet, you don't have any trouble doing it. But try making a 50-pound or a 20-pound bet or a 10-pound bet. And believe me, you're going to want to get to those levels if you're going to make serious money at this. If this wants to be a full-time job, you can't pull 100 or 200 points out of the market today in one day. What you can do, you can pull 20 or 25 or 30 or 35 or even 40 points out of the market. And if your bet is big enough, that can make you the kind of money that this could be a full-time job for you. But you got to have the guts to get in there and to do it. Now, here's where people get confused. When you go to put a trade on for a decent amount of money, you are going to feel anxiety. You're even going to feel fear. But here lies the moment of truth. Do you have the courage to be afraid and act anyway? Because that's truly what courage is. It's okay to be afraid. So, for example, when a policeman has his gun cocked and somebody's shooting back at him, he's probably afraid, but he does it anyway. Or when a fireman is jumping onto the top of a burning building, he's probably scared, but he does it anyway, and they get the job done. So it's the same with trading, guys. It's okay to be scared, but you have to pull the trigger. And what it comes down to is, if you don't have a trigger, if you can't pull the trigger, you don't do any trades, which means you don't make any money, which means you're not going to be able to sit around and call yourself a trader for too long. It's very important to learn to focus and trade your system under pressure. Don't worry about the money. Focus on the execution. You have a stop loss limit, you have money management technique, you have a trade plan, a trade strategy, and you don't really have to worry about the money because you have all these other things in place that are keeping the money under control. You're not going to make a ton of money or lose a ton of money on any one trade. It's a function of doing a lot of trades over a period of time, which is going to determine your results. Now, I can tell you from firsthand experience, having been a bank trader, that once you learn to control the fear, it gets easier and easier in time until there is no more fear. In fact, the opposite can become an issue. You become overconfident and not focused enough on the risk you're taking. That can happen too. Overconfidence, is a problem. It's a serious problem. Trading is not easy, all right? Statistics, we know, is a 95% failure rate. So if you're doing well, don't take your success for granted. Always be on the lookout for ways to improve what you're doing. I still do that to this day. I'm always looking to improve on my systems. Some of you may not be here today, but would know that right now I'm working on 4 or 5 different systems with different traders that they come up with ideas and I work with them. Now, one thing about becoming overconfident too is this idea of getting pumped up to trade. So you get all excited, I'm going to go in there, I'm going to make $1 million and all. You know, you really don't want to be doing that. You want to try to stay as calm as possible on an even keel as possible. You need to be relaxed when you trade. You know, this is not a football game. You know, you don't get all psyched up. What you want to try to do is just relax as much as possible and enjoy it. Now, what you want to do is you want to figure out what kind of person are you? You want to start by analyzing yourself. You know, some of us we thrive on stressful conditions. We're the type of person who's overconfident and probably take more risk than we should. So before you do your first real trade, you need to think about it. You need to think about, what kind of person am I? Am I the kind of person who's going to blow up my account because I overtrade and I'm overconfident? Or am I going to have perhaps a trigger problem, and I'm not going to have a huge loss, but I do have the problem of not doing anything. And you need to really think about this, and you need to call attention to where your stumbling blocks may be beforehand. So even before you start trading with some real money, I mean serious money, you can start getting into good habits from day one. You can correct your problems, but you have to first look inside yourself and see what those problems are. Now, the problem with pulling the trigger, or perhaps being too aggressive in the market, another problem, probably just as big, is staying in your trade. One problem I see is what a lot of traders do is they get into a trade and it's not working, and they get mad at the market, so they exit at the worst possible point. You know, it's one thing to have a bad entry point. It's another thing to compound your problem by having a bad exit point as well. What makes a lot of sense to me is to try and minimize the damage of a poor entry point by a good exit point. And this can be done if you stay relaxed and you don't get all flustered with losing trades, because losing trades is definitely part of the game. Now, if you are having a problem of fear, afraid to trade, remember that so does everybody else have the same problem. You don't want to try and fight it. You want to accept it. You know, what I used to do when it was a problem for me, I used to laugh about it. I'd be like, oh my God, look at this. I'm getting all nervous. I've done 10,000 trades already after a number of years in banks. You know, I've done hundreds of thousands of trades. You know, what am I getting nervous about? You know, it's either going to work out or it's not going to work out. You know, what I taught myself to do is focus on what's important. A good exit strategy based on the actual price movement. You know, it's very important, as God said in Wayne's World, you got to live in the now, man. Worrying about what could be is irrational. You know, basically studying your charts, your news, your stocks, and determining an objective exit point, something based on being rational, is what's critical. You know, it's a critical part of the whole game. You don't make any money from entering a trade. You make money only from exiting your trades. So what are you thinking about when you're trading? One of the big problems is staying in the now. You know, fantasizing about that fancy car or the fancy house or all the shopping you're going to do or how early you're going to retire is not helping you one bit. You need to focus on the trading. What's happening now? What do you need to do now? This is going to determine your future in trading. Thinking about it and not focusing on the trading itself is going to make it less likely that you're ever going to be in a position to get that car, house, or shopping you so badly want. So there's no room for fantasizing in successful trading. Counting up and mentally spending profits you haven't made yet, it's just not a good idea. Another issue for many people is dealing with losses. Worrying they're going to repossess your car, they're going to take your house away, you're going to be poor and desolate on the street, or even worse than that, your wife's going to find out you're losing. These things, there's really no room for them in successful trading. Losing is part of the game. It's inevitable. Get used to it. We all make mistakes. That's why they put erasers on pencils. With good money management, your losses should not be a big deal. Staying in the now is key. Don't wilt under the pressure and do anything stupid and magnify a small loss into a big loss. If you're not trading well, you're losing money and you're getting emotional. It could be the other way around. It could be the fact that you're being emotional and you don't have your head on straight is why you're losing money in the first place. Remember, coolness under pressure is one attribute of a good trader. It's not the whole thing. As we said earlier, you still need good trading system. You need to understand the market and have good money management techniques. Alone, being cool as a cucumber when you trade is not going to be enough to make you successful. So you want to focus on your position you've taken, the trade you've done, have a reasonable stop loss in place, and put that stop loss in at the time you do the trade. You can always change it. Then you can be like an astronaut. You can sit back and enjoy the ride. There's really no sense worrying because you have no control. The market's going to do what it wants to do. The best you can do is watch it and look for signs of when to exit. Now, a couple of things I found useful in the past is don't be penny wise and dollar foolish. If you have a trade signal, make sure that signal is really there. Make sure it's a clear signal. Look for some confirmation if possible, and give it a decent chance to win. By that I mean make sure your stop loss is not so close that you're going to get knocked out by the first little bit of random noise. Remember, we're doing trades, we're trading, we're not buying lottery tickets, which is kind of what using extremely tight stops is. You're like playing the lottery. And incidentally, the reason traders try to put really tight stops is they really don't feel confident that they know what they're doing, which generally goes back to usually a lack of education, a lack of real trading tools, and a lack of money management skill. Another thing I find is that too many times traders give up too easy. When you're trading, a lot of times you have a certain budget. I like to use, when I teach my traders, I like to give them a daily stop loss limit. For example, my son started trading 2 weeks ago, and he has a daily stop loss limit. And he hasn't even come close to it yet. But I told him, I said, that's your daily stop loss limit, and what I don't want to hear from you is that you've ever broken it. But at the same time, I tell him, you do your first trade of the day, because he likes short-term trading. He's mostly trading the Aussie dollar versus the Dow Jones Industrial Average, and he does more than one trade a day. So I told him, don't give up. If your first trade ain't so good, that doesn't mean you're done for the day. Don't get flustered. Don't let the market fluster you. Remember, trading is a process. There's lots of losses and lots of wins. And sometimes you lose because, like in tennis, you lose because your opponent is too good. Sometimes you lose because the market is just not cooperating. The market's tough to read. we try to read the market. So sometimes our judgment's going to be wrong, and that's okay. That's part of trading. We expect to have plenty of losses in trading. It's part of the game. Now, another thing I find is traders trying to do too much is a problem. First of all, you shouldn't try to trade beyond what you know, because that's going to stress you out. So if you're just a beginner, then don't try to trade like I trade, because I've been doing it for 30 years. If you're experienced with stocks but you got no Forex experience, try to gain some experience, some knowledge before you get rolling. Otherwise, you're going to feel you don't know what you're doing. You're going to get all stressed out. And you're kind of out of your own element, which adds to the stress. And be prepared for your skills to develop slowly. Don't expect miracles. This is like anything. It's a performance sport, and it takes time. It takes time and practice to get good. Now, some of us have a problem perhaps of being too smart. We try to outthink everything, no matter what we're looking at. In trading, many times it's as simple as it looks. A lot of times I find traders, especially a lot of my students are smart people. They've had successful businesses. They could even be professionals in doctors or IT or something else. And they try to outthink it, In my experience, a lot of the high school graduate types that I work with in the banks were the best traders because they kept it relatively simple. They had strategy. They stuck to their strategy. They stuck to their money management. And they didn't try to come up with anything way out there, so to speak. Be careful with too much detail. Basically, I like a trading system that has a couple of things it looks at, and that's enough. A setup and a trigger, and maybe a couple other things you look at for confirmation. But try to keep it from getting too complicated, because in the end, that just tires you out. You wind up like the skeleton. Be careful of charity trades. What I mean by charity trades is when you put a trade on and you make money, and then you put another trade on and you have to give back a certain portion of what you made. So your first trade you may have done really well because you had a well thought out trade. Then you kind of just roll in the dice. You feel you're entitled to that because you had a winning trade. And that, giving money back that way is not a good idea, because trading is hard, and you need your profits when you make them. You really can't afford to give away any for charity trades. Try not to spend more than 3 hours a day of quality, focused trading time. That's about all your brain's going to allow you. But when you're trading, be 100% focused. Halfway is bullshit. It doesn't work. Don't even think by spending a lot of hours in front of the computer looking at the exchange rates, that's going to make you profitable. This is not a convenience store. It doesn't work like that. Less is more, but be focused. And try and stay away from the rumors. Rumors are rumors about almost 100% of the time. As a hint. And if you do hear a rumor of any kind, whether it's on a news feed or whatever, try and figure out where the motion related to that rumor started and decide whether it's too late to join the party or not. But in general, expect the rumor to be just that, turn out to be a rumor. And there's a lot of rubbish. The retail trader, they talk a lot of rubbish. They hear a lot of rubbish. So let's go through and try and clear out some of this rubbish. The big guys always get me. Trust me. The big guys, having been one, have no idea what your 1 pound position is. And even if they did, it's too small for them to bother to get you. Now, if you do believe that the big guys are always running your stops and things like this, then you should try to put your trades on where you normally would be getting stopped out, because if that's true what you think, then you would be putting them on at the perfect time. Now, one problem I think the retail trader does have is they avoid the hard trades. In banking, the FX traders, they have an axiom. The harder the trade is to do, the better the trade. And this is something I learned from experience. So when I needed to buy euro dollar, and I was trying to buy them and the price was going up real quick against me, then I knew I had to go in there and buy them faster because that meant the market needed them. And when it was very easy to buy them, I knew that I could stop buying them and buy them cheaper. So if you're thinking about a particular level on a chart to buy or sell, and it gets to your level and it goes through it very quickly, don't say to yourself, well, I missed it. Say to yourself, let me jump in now because my analysis is perfectly correct. That's why it moves so quickly through my entry point. This is something the little guy seems to always stumble with. Another one is the broker always runs my stops. If you read forums and chats in several different places, you can get an unbiased opinion of the brokers or spread bettors out there, and there are plenty of good ones out there. They're only going to run your stop if your stop is within a couple of points, literally 1 or 2 or 3 points from the current market price. They're not going to run your stop if you're 20 or 30 or even 10 points away or more. Because they have to go through all the other orders on their book in order to do that. It just doesn't happen. It's just something the retail trader, because they're unsuccessful, they look for excuses, and the broker always runs my stops. I think a more appropriate thing to say is I always put my stops in the wrong places, or I always do the wrong trades. And doing the wrong trades a lot of times is trading against the trend, the prevailing trend, trying to pick tops and bottoms, ignoring the fact that it's already moved quite a bit and expecting it to go further. These are the things that you should be thinking about and not trying to blame it on the spread better or the broker because you're giving them too much credit. This one here I love. I always lose. Well, that settles it. If you believe you always lose, then it's very difficult to improve your trading. I think the 4 top reasons why traders lose. Number 1 is a knowledge deficiency. They just, if you don't know what you're doing, if you've never taken the time to learn to trade properly, if you don't really understand the market you're trading, that's why you're losing. Overtrading, just doing too many trades, periods. You're trading often with tight stops, tiny profits. The only one getting rich there is your broker. Taking too much risk, you're risking a large percentage of your account on one trade, and you're staying with that trade too long. You're not quick enough to get out of the trade. That's another good reason why you're losing. And if you put your stop losses too tight with the retail brokers, this is a recipe for disaster. If you're going to put on a trade, give it a reasonable stop loss that allows your trade a fair chance to develop. So, for example, in the euro-dollar pair, a stop loss of, say, 50 points. Let me scratch that. A stop loss of 65 points is a very fast stop loss where if you're right about direction for that day, you will not get stopped out of your trade. Even 55 may be enough. But if you seriously want to give your trade a reasonably good chance, again, what we have at the retail level is we're playing lottery tickets. We're putting 10-point stops, 5-point stops. They're just too close to the market. And, the last thing is a lack of confidence, confidence comes from successful trading. So if you start off losing because you're doing it on your own, you're going to learn it on your own. A professional at anything. A doctor doesn't say I'm going to learn to be a doctor on my own, or a dentist doesn't say I'm going to learn to be a dentist on my own. There's a process, a learning process. And too many times traders don't have any confidence in what they're doing, and their results show that because they never really learned to do the skill. They just jumped right in, and that's a mistake. Another one is I'm bored, so I'm going to put a trade on because the market's not moving. Well, think of it this way. You're paying a spread or a commission or both to do a trade. So why do you want to pay the toll, the spread, if it's not moving? If the market's not moving, there's no reason to do a trade in the first place. It's the same with exiting a trade. You know, you shouldn't exit a trade because you're bored, nor should you enter a trade because you're bored. And being bored in trading is part of the game. You know, a lot of the time in trading is boring. That's just the nature of what trading is about in the real world. It's only on television where it gets sensationalized, where it's always exciting. Trading is boring 20 out of 24 hours a day. Get used to it. Now, the opposite is a lot of times retail traders complain the market's moving too fast. And mostly this is around news time. You know, the volume's high, the price actions are fast and furious. You know, there's good money to be made before, during, and after the news. And the news, how it moves after news is actually quite predictable. There's a lot of bad propaganda about the news in general from the brokers and spread bettors because they're market makers. And when the market's moving fast in one direction, they're doing all their trades in one direction and they're losing money. So they don't want you to get involved in trading the news because they cost them money. Now, another problem is the news reporters. You know, if you go to Bloomberg Television and you see the pretty girl or the handsome guy up there, and he's getting ready to report the non-farm payroll, if the people working with him said, would you like me to touch up your hair, or would you like to read the non-farm payroll preview, he would say, touch up my hair, because they're actors. You know, they're not traders. The only value you should be getting from your news people is not their opinion of the market, not their analysis of it, but simply to tell you the facts. What was the actual news event? Everything else you should have, you should interpret and trade from your own knowledge. You know, I put out, say, a news trader every week. I say, this is news is coming out. This number will make it go up. This number will make it go down. And this is how to trade it. So all I need from the news service is to tell me what the number is, and then I go in and do my act. I don't need them to explain to me what should happen in the market because, frankly, they don't know. Now, along the lines of losses is the idea of it'll come back. You know, now Harry Houdini, the famous magician, said that he'd be back. He ain't back yet, and a lot of the traders who said it'll come back are no longer trading. Now, you don't want to get confused with being courageous because you're sitting there taking a huge loss on a trade. That doesn't make you courageous. That makes you a fool. That's just stupid. So if you don't have the, I believe you're a total coward if you don't have the guts to take your loss when you're supposed to take your loss. The trade's not working, you take your loss, you move on to your next trade because you have the courage to say one trade's not going to make me a success or a failure. Well, it could make you a failure if you blow your whole account. People have done that. You know, so that it'll come back idea, you know, we need to get away from that. And part of that is a concept called loss aversion. And it's just a human instinct. We tend to be slow about taking our losses and quick about taking our profits. It's called loss aversion. It's just a psychological term. I think many of you are just afraid to take a loss. You know, you think it's personal. You think it makes you a bad person. You know, I don't think doing a poor trade is a reflection of you. It could be you were just a little ahead of your time. It wasn't the right kind of a market. A commercial order hit the market and temporarily creates a small unexpected move. You know, again, you want to get your stop loss in there beforehand. There's my stop. I'm sticking with it no matter what. You know, If the trade's going bad, it's probably going to get worse. That's the way I look at it. I think it was Einstein that said, what goes in motion stays in motion. Maybe it was Newton. I get mixed up with these guys. Another problem is rationalizing. This is a killer, an absolute killer. You know, if it hits your stop loss order, don't think to yourself, I think I'll give it a little more room. Think of it like a prize fighter. If it gets to your stop loss, and let's say you're a prize fighter, he just got hit with a big punch and just got knocked out. Well, moving your stop loss is kind of like saying that prize fighter that just got knocked out is going to get up and he's going to knock out his opponent. I don't think so. He's going to get up and start staggering around. So when you have a trade on and it's gone really bad, chances are it ain't coming back. Not in the time period or not in the amount of your account. And that's what you want to think about. You know, you need to learn to accept losses as part of the game and not be hoping, like Harry Houdini, that it'll be back. This one here is big among the retail clients. It has a 5-to-1 risk-reward ratio. That makes it a good trade. There is zero advantage in risk-reward. If you set up a trade with a 5-to-1 risk-reward, what that means is you're trying to make 100 and you're risking 20. So when you do that, if it has to go 100 points for you to win or 20 points for you to lose, most likely you're going to lose 4 out of 5. That's what's probably going to happen. So it's more or less a break-even situation. The risk-reward means nothing unless you're relating the risk-reward to the likelihood of the trade working out. So sometimes you'll look at the charts and you'll say to yourself, well, I think it'll go down 50 before it goes up 50, and I think it's got a much better chance of going down 50 before it goes up 50. And since you're going to make 50 or lose 50, a 1-to-1 risk-reward, you think your chances are better than that, or the probability is higher, then there may be a little advantage in the risk-reward. But just taking high multiples of risk-reward for the sake of taking them, that's what a lot of the educators teach, and it sounds good in theory, but they kind of spin it like a pot of gold to make it appear that you're going to win one and lose one, win one and lose one, and when you win, you're going to win 5, and when you lose, you're going to lose 1. When the reality is, if you're trying to make 5 times as much as you're risking, you're going to lose almost all the time, just win very occasionally. So don't get wrapped up on risk-reward. One of my favorites, I back-tested it. You know, what you want to be very careful with is back-testing. Okay, because what's happening there is you're looking at what already happened and you're taking what already happened, so you already know the result, and then you're trying to make believe that you figured out what's going to happen, what happened in real time. They're two totally different things. They're totally different. So, for example, I was talking to my son about this, and we were out in California a few weeks ago at a Forex and futures. I don't know what they call those things, where they have a whole bunch of different people come and speak, and we just went as guests, you know, just to listen to other people speak. And one guy was saying that, you know, my system has made 96% a year for the last 10 years based upon rigorous backtesting. So I said to my son, well, what's wrong with that? And he said, well, Dad, in science, when I was in school, when you have an experiment, you have to draw your conclusions of what you think is going to happen, and then you test it. What he's doing is first he's getting the conclusions, and then he's making believe he's testing it. He says, Dad, in school you get a lot of trouble for that. You can't first figure out the answer and then come up with your theory of what the answer must be, because you already know the answer. And that's essentially what backtesting is. You know, I think you want to be very careful. I think it creates a false sense of security when somebody tells you they back tested something and it worked out so well, because what they're really saying is, with the benefit of hindsight, with the benefit of knowing the results, I had this great trading system. So be very, very careful of hypothetical or black box results systems. These days they even have a new term they call gray box. But it's all the same thing. They're not telling you what they're doing. They're saying that they made tons of money, but it made tons of money with the benefit of hindsight. And I think all of us would agree, if we knew that the FTSE was going to be at 10,000 by the end of this year, we could all make a lot of money trading the FTSE, and we wouldn't need a very sophisticated system to do so, because we already know the result. So be very careful of back testing. Try to think one currency at a time. You know, you want to trade you want to be focusing on trading a currency and not a pair. You don't want to think of it as a pair, what a lot of people do, for example, is they go, I think the dollar looks good. And then they arbitrarily say, oh, well, it looks like the euro is a little weak. I think I'll just put it against euro. You see, that's not good enough. What you want to do is focus on, how do I think the dollar's doing? How do I think the euro's doing? And how do they look as a pair? You don't want to just look at it as a pair. You want to break it down and look at it one currency at a time. This is what good traders do. Now, when you first start out, it makes a lot of sense to just start off trading one pair. It's like the euro-dollar pair. But focus on learning about the euro, learning about the dollar, what causes them to move, etc. For example, there's very specific things right now that are causing the euro to move. A lot of it has to do with problems with the member currencies, the member countries' the member countries' governments' debt problems, and the U.S. dollar, believe it or not, is being driven to a great extent by what's going on in stocks. So when you put the two of them together, it tells you how to see where the euro-dollar pair is going. From that point, when you take out the charts, at least you have a clue of what should be happening, and now your technical analysis is telling you, is it happening the way it normally will be happening? It's giving you an extra edge by looking at it one currency at a time. That's what it comes down to. Now, demo accounts, what you need to realize about demo accounts is that they're make-believe. So you can't pay your mortgage with demo money. And the demo accounts that a lot of the brokers use, a lot of the spread bettors use, they are a shield game of sorts, in that they even tell you that the demo account the price action in the demo account doesn't behave exactly like the price action in the real account. You can get a lot more stuff done in a demo account that you wouldn't be able to get done in a real account. So you don't really want to be trading in that kind of an environment. The only purpose of a demo account is to learn how to use the functionality of the platform, how to put in the different kinds of orders, to understand the mechanics of how everything works. Then a demo account is okay. But when you want to start trading and keeping track and getting serious, then you have to put some pence, maybe not a whole pound at first, but maybe 10p or 20p for a month or so to get used to it. But don't start trading in a demo account thinking it's real, because it is a different kind of account. It's not the thing you'll actually be trading when you trade for real. Now, there's a couple of things you want to think about, like thinking long term. Basically, I would say don't do it. You need to stay in the moment, especially if you're going to be the kind of trader who puts a trade on and plans on keeping it on for part of the day, a matter of hours, maybe a couple of days at most. Because in that case, it doesn't really matter what happens next week or next month. If you're trading with a 30 or a 50-point stop, you want to restrict your thought process to what's happening right now in that immediate time frame, which kind of means the next hour or two. That's not to say the long term is not important. It is to say the long-term trend is not really going to be that helpful when you're trading in a shorter time frame, a much shorter time frame. Now, there's such a thing as trading too short term. If your profit target is 20 points or less, and your spread is 3 points or more, I wouldn't even do the trade. As a rule of thumb, your spread and the number of points you're looking to make on the trade, your spread shouldn't be more than 20% of that number. So if you're trading, and preferably 10%, so if you have a 2-point spread, a 20-point profit is perfectly reasonable. But a 5-point profit isn't, because if you have a 2-point spread and you're trying to make or lose 5 points, it's costing you 40% in the spread alone, to say nothing of the fact that the brokers can jiggle the price and your spread bettors by 1 or 2 or 3 points from the very most current market. It's possible that can happen to you as well. So the combination makes it really impossible to trade too short term. So you got to get in somewhere in the middle there. I think 15 to 45 points is a very good area for short-term trading. Now, be careful when you're trading as far as the hours go. This looks pretty much like that sign in Las Vegas, currency exchange open. The bank FX traders, the options traders, the hedge traders, the hedge funds, they all have a huge advantage during the off hours. There's no real interest in trading. The volume's very low, so they can kind of push it around. There's really only one signal during the off hours, and that's to stay out of the market. The good hours are from 7 o'clock in the morning over in London until about midday in the U.S. So the London trading day, 9 to 5 in London time, 7 to 5, that 10 hours is pretty much the good hours for trading. The Asia session is no good, and that's when you're sleeping anyway. But in general, you don't want to trade during those off hours because it'll just get you into trouble. Monitoring your trades is a good idea. If you have an iPhone or a BlackBerry these days, you can hook up with your broker, or your spread better, ask them. They probably have an app. I have an iPhone now, finally got one. And, like Nadania has an app, and they have different apps for the brokers, so you can check on your stuff. If you're going to be trading them when you can't be watching the market, rather than put trades on blindly, it would be nice if you could get a little signal that your level's been reached, and then take a look and decide whether you really want to do the trade instead of just jumping in there blindly. Again, it comes down to not taking this business too lightly, to realize this is not such an easy business. When you're going to trade at home or wherever you're going to trade, try to find yourself a nice quiet spot. This guy here's got a really good spot there on the top of that tree. Probably gets good reception from the internet up there too. Now you want to be careful relying on others. This happens quite a bit on the internet. Like, for example, I have a Twitter group called Jimmy's Traders, and it's my students get together, some of them, and they talk about the market, etc. That's okay, and it's good to share ideas, and it's good for you to get ideas, especially if you're new at trading. But when you get to the point where you're a serious trader, you do play a lone hand. You make your own decisions, and you don't rely on others to make the decisions for you. There really is no halfway. Either you trade for yourself or you have someone else trade for you. I actually had start talking to somebody about this, and they said, well, I want to know when to enter the trade, exactly, and when to exit the trade, exactly. And my response was, well, with all due respect, exactly what kind of a trader does that make you? If I'm going to tell you exactly when to get in and exactly when to get out, well, that doesn't make you a trader then, because that doesn't leave you any function. So, and I explained that the exit part is, the entrance part can be very detailed and exact. It's the exit part which makes you a trader in the first place. Now, we're going to need a trading plan. If you don't have a trading plan, a method, or something, it doesn't have to be a big deal. You can put it on an index card. It doesn't have to be a big detailed thing, but you need some kind of a plan. Because when you don't plan your trades, then what you're doing is you're just kind of winging it. So you get a thought, you get a thought. A thought is not an idea, okay? A thought is an emotion. So if something pops into your head, you throw a trade on. That in the long run is not going to be good enough to be a successful trader. We want to be consistent. We want to follow a certain method, something we write down, a set of rules, that you're going to follow. Now, the rules don't have to cover every single little thing you do, but you definitely need rules in terms of stop losses, daily trading limits. These rules you really need. When you'll trade, when you don't trade, under what conditions you take trades. You want to write that down. You want to make a plan, have your rules. You want to follow them and set goals for yourself, and you will achieve them as long as you have some kind of a structure or plan of what you're going to do. Now, a lot of people say, making money, that's my plan. Making money is not a trading plan. A trading plan spells out where you see your edge on the market as being. If you don't have an edge, you don't have a plan. Likely you're going to wind up as one of that 95% losers. The first thing you need to come up with is some kind of a trading strategy, not a trading system, but a trading strategy that's going to produce profits. That's the first thing you need. And make sure whatever plan you come up with is something you're actually going to follow it. Because if you're not going to follow it, what's the point of having it? One trader, his name's David, he was on Twitter the other day, and there was a trade which it was a system signal it was a bad signal, and he mentioned right on Twitter that was a bad signal for these three reasons: 1, 2, 3. And I responded to him and said, "That's excellent, David. That's beautiful analysis. That makes perfect sense." And he emailed me back and he sent me a spreadsheet, and it had every trade he'd done since he started trading, why he got in, why he got out, how he did on the trade, what he learned from the trade. And he's like doing really well. You can see the progress he's making because he's making a tremendous effort. And he's really learning from every trade, and he's got a plan. He only takes trades under certain conditions, and he's learned from experience of actually trading the systems, not based on any theoretical stuff, but from actually doing it. Very proud of this gentleman. He's doing extremely well. So the way it works, guys, is you learn first, and then you do it. This is the way it is. You learn how, you get your knowledge of how this works, you get some skills, some tools, some systems to work with, and then the execution comes after that. It's a process. You need a profitable strategy, you need to have a clear head, you need to practice, and you have to say it's going to take some time. This is not going to happen overnight. Trade entry, for the most part, can be black and white. It should be rule-based for the most part. Under these are my trade signals, and these are a couple of things I do to interrogate them. If everything lines up, that should be pretty much black and white as far as trade entry goes. What I try to do is I try to cherry pick the very best trades. I try to find those trades that everything just looks perfect and just do those trades. Is it fun? No. Do I miss some good trades sometimes? Yes. Do I miss a lot of bad trades? Yes. Now, trade exit involves many conflicting choices. It's never that clear. But exiting the trade is where you get your results. It's what defines you as a trader. Nobody ever made a dime from entering a trade. You make your money from exit. So the trade exit is never easy, but it's where, when people tell me, well, how do I exit? Tell me exactly how many points I should go after and all this other stuff. Well, you have to learn to read the market. You should exit the trade when the potential of the trade is a lot less, when you have a good profit, when there's signs from other things besides that particular currency pair you're trading that the trade may start to go the other way. There's lots of reasons why you should exit a trade, but that's what makes you a trader. If you expect somebody to tell you when exactly to get in and when exactly to get out, then what is your function in the process? You don't seem to have one. You have to be willing to work on the exit because that's what makes a trader. Now remember, not every trade is going to be a winner. What you want to focus on is not the P&L of each individual trade. What you want to focus on is a flawless trade execution. You have your entry criteria, you have your exit criteria, you're reading the market, you have an idea what's going on with the news, and you make your decisions intelligently, unemotionally. This is what being a trader, having composure. This is what trading is all about. The ability under stressful conditions to do something that's very difficult in a very timely manner. This is what being a trader is all about. So the three-step process, you need to be prepared to trade. You need to study your markets beforehand. Maybe you have a daily routine you follow to get a feel of what's going on. You look at the stocks, you look at the news, you look at the charts of various currency pairs, etc. And from there, you wanna trade without fear, which means you need to take comfortable risks. You risk a small amount of your account, and you're trying to make a small amount of profit. This is what comfortable, fun trading would be like. You're not going to get rich overnight, and certainly if you're not careful, you could go to the pool house overnight. But you need to learn to trade without any fear because we're trading amounts we're comfortable with. We're trading for who we are. If we're a beginner, we're trading in a beginner way, which means little tiny positions and mostly learning. If we're a very seasoned stock trader, we're just trying to get the edge of how the Forex works. We already know all our technical analysis, etc. Again, it needs to be comfortable. There should be no fear. And we want to realize the profits. We don't want to drain them away. So you get a decent profit, you take it. Don't dream of making tons on it and let it get away. And certainly find a way, whether it's with a handheld device or whatever it is, when you have a decent profit on a trade, you don't let that turn into a loss. You make sure at worst you don't give up any money on the trade. Now, before you give up on your trading, say, this ain't for me or whatever it is, there's a few questions you need to ask yourself. First of all, do you have a profitable trading strategy? Do you have something, an edge on the market? Do you have something that's real, that actually works? And if you do, are you following it? Are you staying in the now? Or are you fantasizing about profits or worrying about losses unnecessarily? What about your risk taking? Are you taking reasonable amounts of risk, or is it not working for you because every time you do a trade, you're just a nervous wreck because you're risking too much? You want to ask yourself, so what are my strengths? What are my weaknesses? What do I need to get back on track if I fell off the track? And be very specific. Before you give up, go through this process and try and figure out exactly where you're at and what you need to do to get things to where you want them to be. Whether that's education, some profitable trading systems, some new money management, better money management, learning to relax, whatever it is you need. Okay, so we are done for today. It's today's lesson. I hope you enjoyed that. Lesson on psychology. Next week is our final, the sixth of our 6 sessions, and that's going to be on. We're going to take a good look at a spread betting platform, a live one. We'll go through it step. Actually, I take that back. It won't be a live one because it'll be 7 p.m. Well, maybe it will be live. Oh yeah, it should be still open. Yeah, should be able to look at a spread. Remember, I can't use a spread betting platform over here. I'm not allowed to, but I'll see what I can do. I'll see if I can't scrounge one up from a friend. And we'll take a look at one, and we'll go through everything. How you put trades on, the whole shebang. And that's what we'll spend the session on. Okay, that's about it. I'm going to end the session now. I will take a couple of questions. Just give me one moment.